Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning, everyone. This is Quincy Krosby. It is Tuesday morning, September 5th, and this is The Talking Point. Thank you for joining me. First of all, last week was a really busy week for the market. Just before a shortened week this week, we had a lot of economic data. And overall, what it showed was that perhaps that the economy is beginning to soften. Not collapse, but soften. The package of data that we had last week pointed to a couple of things. One, that the consumer, remember, we are about 68% of our economy's GDP, that our spending continued. Oh, yes, it did. But personal income came down just a bit. So that's, you pay attention to that because obviously that is not going to continue. It can't continue if the labor market does not hold up. Now, let's go over to the labor market. What we saw last week was, from the data, was that, hiring has slowed. We had a higher report, more than we had expected, but it was under 200,000. And the unemployment rate climbed up to 3.8%. Now, that's still a strong labor market. Please keep that in mind. But remember, when we look at economic data, it is always the trajectory of data. So in other words, 3.8 is fine, but if it keeps moving up quickly to cross over, say, to 4 and move up quickly, that takes the market's attention. And why? Because it tells you something is going on. There's a transition taking place. Please remember that, a transition taking place. In any series of economic data, we look for that. But in and of itself, 3.8% unemployment reflects a strong labor market. We also saw the participation rate pick up. Now, I'm not going to get into this in this call, but when you have more people coming into the labor force, one of the things that it does is, obviously, it increases the pool of applicants for work, but it also means that if I have a job, I am not going to be that quick to quit my job and jump to another one, because it means that the employers have more choices. The more choices they have, the more that they can keep a control over wages. That's the theory, is it not? That's the theory. It makes sense. The other thing that we saw last week was the job opening and labor turnover report. Now, that one, there's a question mark about whether or not the survey really works, because obviously I could put job openings on many different platforms. So does it show up in 3 different platforms? Be that as it may, the one thing that we saw last week were job openings and labor turnover pulled back, meaning that there were fewer jobs listed, still very good, mind you, but coming down. And we saw the quit rate also slowed. We tend to quit our jobs for another job that's paying better. Normally, that's the normal, I would have to say, equation over these, number of years. That slowed down. So I take that. And then also the ADP report that comes out on Wednesday, which is the private sector report, doesn't include government jobs. There, we saw fewer jobs than we had expected, than the consensus estimates. We take that, and we also add one more piece to this mosaic, if you will, and that is the consumer confidence report that came out last week. Now, please keep in mind there are many different consumer confidence reports, but last week we had one of them, and this is the one thing that was important in that one, and that was that consumers said they were worried about finding jobs. very interesting, right? Because we came from a scenario where jobs were plentiful, so plentiful that at one point we were getting bonuses, signing bonuses, and wage hikes. So that was interesting. The other thing that folks were saying, and consumers were worried about higher prices for food and gasoline. No surprise there. Now, when the report came out on inflation, that was last Thursday, right? Friday we had the employment report, but last Thursday, the market rejoiced because it showed that inflation is coming down. It is coming down. It is pulling back. This is from the so-called Fed's preferred inflation report, not the CPI, Consumer Price Index, but the report, what's called the PCE, that comes out. That is more directed by information that comes from employers as opposed to the Consumer Price Index, the CPI that we all talk about, that benefits are based on, that comes directly from surveys from consumers. But in any event, it showed that prices are coming down. However, there's still stickiness at the core, and that is important. But be that as it may, what happened when that came in, that number came in, also when the payroll number came in, and the whole swath of data releases last week had the futures market, the probability of rate hikes. Remember, we're looking at September, November, and December. September came down even more, but the market knew that September, that's this month, September 20th, is not in the cards. But we did have November and December as a distinct possibility for another rate hike. That also pulled back. And the question now as we go into this month is the data that we have. Is that going to push up the possibility of another rate hike? We'll have to see, because the Fed is data dependent, and so is the market data dependent. Now, this week, in terms of data, we have factory orders today. The expectations are that they come in lower than the last month, and with a minus sign. So those would be factory orders. Also, tomorrow on Wednesday, September 6th, we are going to have a look at the ISM services. That was another one that last week we had the ISM, Institute for Supply Management, Purchasing Managers. That's who come, that's based on their reports. The manufacturing report came in, and there, by the way, it looked as if maybe we are bottoming out in terms of manufacturing. In other words, forming a bottom. Doesn't mean it was positive. It just means it looks like it wasn't getting worse, which it was not getting worse. But prices paid did climb higher. But we will get this on the services. And we always have to remember, this is a service-led economy. And we want to make sure that this is not, declining at a rapid pace. We want to make sure it stays above 50, because the line in the sand is 50. Above 50, we are in expansion territory. Below 50, we are in contraction territory, and that is where manufacturing is. Also, we will have the Beige Book on Wednesday. I look at the Beige Book because it is an up-to-date report. Remember, most of the data that we look at goes back a month. Absolutely goes back a month. The Federal Reserve Beige Book is much more up-to-date. It's anecdotal. The Federal Reserve banks talk to small business owners, they talk to banks, they talk to large business owners to get a snapshot of how their region looks in terms of the economy. And it's important because we're looking for up-to-date reports. And one last thing about this, which I think is quite important. We are obviously a very large economy, and it's regionally based. So, for example, in housing, we see where housing picks up. We see where housing declines. We see where infrastructure spending picks up, where it's in decline. And the same thing with the Beige Book. We'll get a regional snapshot. And then on Thursday is a parade of Federal Reserve speakers. But I'm looking at the list, and the majority of them tend to be much more in the dovish camp. We have some hawkish doves in there, and we have one, I would have to say, a hawk coming out and speaking. But we want to hear what they have to say. Now, keep in mind when we listen to them, it doesn't mean that the Fed is going to move in their direction. Remember, the Fed is data dependent. And what was interesting, however, was last week we heard from Loretta Mester. Loretta Mester is head of the Cleveland Federal Reserve Bank. She is in the hawkish camp. And basically she said, look, I'm impressed with the fact that, inflation is coming down. Yes, I'm acknowledging that. But we still have inflation. And that led the market, by the way, to basically suggest a little bit maybe more of a possibility that the hawks will come in across the board, pushing for another rate hike. It's important to pay attention to what they have to say. And then on Friday, we'll have consumer credit. And it's going to be, I wouldn't say it's a dramatic week, but it's, again, an important week. And here's another reason. The 10-year Treasury yield, as I do this call this morning, has climbed higher. We want to pay attention to that because that has typically had a negative correlation with how the equity market is faring. We went from a 10-year Treasury yield that had come down quite a bit with the data that was released last week, and now it is moving back up. Let's keep our eye on that, particularly as the data comes out this week. There isn't that much data this week, but we'll see how it affects the 10-year Treasury yield. In addition to that, we had, at the same time, oil prices climb higher. So if you take a look at that, you're going to see both Brent and WTI. WTI is the benchmark that we use in the U.S., West Texas Intermediate Crude. That has inched higher. So we're going to watch that very, very closely. P.S. about China, before I close this call, they're coming in and supposedly this is working. They are lowering some of those mortgage rates, in essence, putting it on sale for those who want to buy condos. Also removing some of the obstacles, registration, and so on, obstacles that some of the Chinese population faces in areas outside of the main cities. Apparently it is working, which would be helpful for their economy. This is, something we're watching. And also, one of the big property developers that is on the cusp of the major default actually made a payment, which kind of, took everyone's breath and said, "Woo, that's good news." But you also have some of the cracks showing in with other property developers, and you also have issues stemming from the shadow banking system in China, with what we would call some of the banks there that have unit trusts that make regular payments, but have halted payments. So our eyes are always on China. So that's it for this week. Please join us next week. We'll be back on Monday next week. Have a very good week. Thank you so much for listening.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and investment advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.